Hey everyone. Let's start with the question that immediately grabs attention and frankly makes a lot of investors stop and think. Why would a company willingly give away a massive portion of its ownership? Not a small bonus, not a few executive shares, but millions of shares. In the case of Datavault AI, we're talking about 7.5 million shares of common stock. That's not pocket change. That's a serious statement. So the real question isn't why they issued those shares. The real question is, what did they get in return that was so valuable, so strategic, that management decided this was worth it? Because companies don't do this lightly. This move wasn't desperation. It wasn't about paying bills. It wasn't about raising cash to keep the lights on. This was something very different. What Datavault AI essentially did here was draw a very clear line in the sand and say, this specific technology is our future, and we are willing to pay the highest possible price to secure it permanently. And that price was ownership. Now let's break this down step by step because this is where confusion usually creeps in. According to the official public filing, the Form 8K makes it very clear 7.5 million shares of common stock were issued, and those shares went directly to the original inventor and additional contributors. That part is not speculation, that's documented fact. But context matters. And in investing, context is everything. Normally, when a company issues shares, it's for liquidity, payroll, marketing, operating expenses. It's essentially borrowing from the future to survive the present. But that's not what happened here. The filing specifically states that these shares were issued in exchange for intellectual property rights. That distinction changes everything. Instead of viewing this as dilution to cover expenses, investors should see it as something much closer to a capital acquisition. Think of it this way. If a manufacturing company issues shares to buy a factory, investors don't panic. They understand that the factory will generate revenue for years to come. That's exactly what's happening here. Except instead of a physical factory, Datavault AI acquired a high-value intellectual asset, and the valuation is what stands out. By issuing shares instead of paying cash, Datavault AI is effectively saying this technology is so valuable that we're willing to make its creators permanent owners of the company. That's not a short-term decision, that's a generational one. This brings us to one of the most important concepts in technology investing, the idea of an intellectual property moat. You hear the word moat thrown around constantly, but what does it really mean? In simple terms, a moat is what protects a company from competitors. For Datavault AI, this moat has two layers. The first layer is legal exclusivity. By owning the intellectual property outright, not licensing it, they permanently prevent competitors from using the same patented methods. The second layer is practical difficulty. Even if someone wanted to build something similar, they would have to spend years, millions of dollars, and still risk legal challenges. If this technology had only been licensed, competitors could eventually work around it, or worse, the original owner could license it to someone else. But by acquiring it outright, Datavault AI did two critical things. First, they permanently locked competitors out. Second, they positioned themselves to define the industry standard. And that's where real pricing power comes from. If you control the standard, everyone else has to come to you. This isn't just about owning good technology. It's about owning the only legally monetizable version of it at scale. That's why the share issuance, while large on paper, actually sends a very bullish signal. Management is clearly saying that whatever dilution exists today is insignificant compared to the future revenue they expect this technology to generate. So now, the obvious question becomes, what exactly is this technology? The filing itself is intentionally vague. It simply refers to certain intellectual property rights. But when you look at the timing, the picture becomes much clearer. The Form 8K was filed on January 15th. Just one day earlier, on January 14th, Datavault AI released a separate press announcement detailing a newly patented AI system designed to evaluate bias and veracity in news content. That timing is not random. It strongly suggests that the intellectual property acquired in exchange for those shares is the engine powering this new service. The company refers to it as a bias meter, and it goes far beyond traditional content analysis. Most AI tools today simply analyze keywords. They scan text for obvious signals. This system does something much deeper. It evaluates not just what is being said, but how it's being said. One of the most novel elements is something called inaudible tone detection. This means the system can analyze emotional framing, linguistic pacing, word selection, and subtle psychological cues designed to influence readers. In other words, it measures the emotional fingerprint of content. In a world overwhelmed by misinformation, sensationalism, and agenda-driven narratives, having a verifiable neutrality score becomes incredibly valuable. For media companies, financial news platforms, and institutional publishers, credibility is everything. If you can prove, not claim, but prove that your content meets objective neutrality standards, that's a massive commercial advantage. This isn't just theoretical either. The partnership with FinTech TV confirms that this technology is already being deployed and monetized with real clients. That's a key point. The shares weren't exchanged for an idea or a prototype. They were exchanged for a working, revenue-generating product that dramatically increases the value of the intellectual property. Now let's talk about leadership alignment, because this is another critical piece. The shares were issued to the original inventor, and according to the source material, that inventor is closely tied to CEO Nathaniel Bradley, who holds more than 70 patents. Effectively, the CEO transferred his own intellectual work into the company in exchange for equity. From an investor's perspective, that's powerful. It eliminates future conflicts of interest. It prevents the possibility of that technology being licensed elsewhere. And most importantly, it ties the CEO's personal financial success directly to the long-term performance of the stock. This isn't management cashing out. This is management doubling down. It sends a clear message. Leadership believes the shares they received will be worth far more in the future because the technology they delivered will drive massive revenue growth. And that belief aligns directly with the company's public financial targets. Datavault AI has openly stated revenue goals of $400 to $500 million by 2027. Those are ambitious numbers. Exponential growth like that doesn't come from generic software. It requires proprietary, legally protected technology with scalable licensing potential. This intellectual property acquisition provides exactly that foundation. Instead of selling time, labor, or generic cloud services, Datavault AI is selling exclusive, patented metrics. That kind of revenue is high margin and highly scalable, exactly what analysts want to see. And that's why analyst sentiment has begun to shift. Price targets as high as $4 and above are now being discussed, representing potential upside of several 100% from recent levels. Why such a dramatic re-rating? Because the valuation model has changed before. Analysts may have questioned how the company would realistically hit those revenue numbers. Now they see that Datavault AI has legally secured the core technology needed to monetize its growing infrastructure. And that brings us to one final crucial distinction. Datavault AI is not just a software company, it's an infrastructure company. Instead of selling a single app, it's building the physical and digital backbone of the AI data economy. Data collection points, processing hubs, networks spanning over 100 cities. But infrastructure alone doesn't generate massive profits. The real money comes from owning the exclusive right to monetize the data flowing through that infrastructure. That's where this intellectual property comes in. The bias meter, the tone detection, the patented analytics. They function like a proprietary toll booth on a massive data highway. And that's why this move matters so much. This wasn't dilution for survival. It was dilution for dominance, and understanding that difference is what separates surface-level analysis from real insight. This video is made for educational and informational purposes only. Nothing in this video should be considered financial advice, investment advice, or a recommendation to buy or sell any stock or security. I am not a registered financial advisor, and the information shared here is based on publicly available sources and personal opinion. Stock market investments involve risk, and prices can go up or down at any time. The companies, stocks, or technologies mentioned in this video are discussed for awareness purposes only. Past performance does not guarantee future results. Before making any investment decisions, viewers are strongly advised to do their own research or consult with a qualified financial professional. I or this channel will not be responsible for any financial loss or gain resulting from actions taken based on this video. You are solely responsible for your investment decisions. Invest wisely and always remember that investing is subject to market risk.